Um, Welcome to the FIAZI meeting with Bloomberg Intelligence. I'm Ralph DeCesar, a board member of FIAZI, also head of credit research at TD Asset Management. Those of you new to FIAZI, we hold monthly meetings on finance such as today's, with recent past events such as Women in Fixed Income, a talk with Jim Bianco, and also an interview with Howard Marks. Please go to our website at www.fiazi.org for information about past and upcoming events, including our ESG conference this spring. Today, we have Bloomberg Intelligence, a very valuable service available on your terminal. I believe this is the fourth time Bloomberg Intelligence has presented to FIAZI, and we're very happy to have them again. There's a lot to cover. So let me hand you over to your host, Joel Levington of Bloomberg Intelligence. Joel?
Hey, thanks, Ralph. And thank you to the folks of FIAZI. Ralph is completely right. This is our fourth event with FIAZI since BI Credit was founded a little over 8 years ago. And it's always great to spend time with your members. For those that are new to BI, Lauren, if we can go to slide 2. There we go. On slide 2, you can see just how large the global franchise is for BI. Over 400 publishing analysts and strategists around the globe, covering more than 2,000 companies, 550 credits, ESG, and litigation. We also aggregate over 500 third-party data sets on our dashboards. So really quite an amazing accomplishment for Dave Dwyer and the Bloomberg team in the 12 years that BI has been around. Lauren, if we go to slide 3, you'll see that we have a great lineup for today. We have 5 of our analysts giving you their best picks and pans. But first, we're going to go through and have a digital roundtable discussion on the explosion of M&A activity and really what it means for fixed income investors. Now, just as a backdrop, M&A was a key theme in 2021. There was more than $6.6 trillion of deals announced. And despite increased market volatility, be it from rising rates or inflation, and obviously the unfortunate war between Russia and Ukraine, M&A is on track this year to be over $6 trillion market. Now, just as a data point, $6 trillion would make it the third largest in the history of, at least in the history of data that we have at Bloomberg, which spans more than 25 years. So our team of analysts have assessed what deal activity means, not only for their sectors, but individual credits. And all of their collective work can be found on the terminal at BI Cred Go. We're fortunate enough to have several of the members here with us today to discuss their key takeaways. Lauren, if we could go to slide 4. All right, thank you. Let me introduce the analysts on the panel today. Steve Flynn is our team leader and our in-house guru on telecom and media. Mike Holland is our senior healthcare analyst. Jody Lurie is our senior analyst covering the leisure, gaming, and restaurant space. Mary Gilbert is one of our senior analysts covering food and beverage. Mike Campellone is an analyst covering the retail sector. And last but not least, Arnold Kakuda is our senior analyst covering the North American banks. So let me welcome the group and start with Arnold. And maybe we can just have everybody's names up or pictures up, and we can get rid of the slides for now. All right, thank you. All right, so hey, welcome, Arnold. And let me start with you, since you did a tremendous job of putting together the team decks. We had a series of M&A decks that went out over the last couple of weeks. And again, that is on the terminal at BI Cred Go. Now, maybe I should start with you, Arnold, because there are a lot of hung deals that are out there right now. And I'm sure one of the questions that you get a lot are, what are the potential downside risks given market condition? What are the risks to the bank balance sheets if capital markets freeze up for M&A financing?
Yeah, well, thanks for having me, Joel. And you know, it's great to kick off. Well, yeah, so I think the questions and concerns right now are, you know, what's going to happen if you know, we see a continuation of kind of markets being, you know, unsettled and stuff like that. Actually, good news today, though, is, you know, this S&C deal that I think was kind of held up last week is I think relaunching today. It's being syndicated out. So yay, it's, you know, no hung deal there. But of course, you know, it's not launching at kind of the 99, 90.5 ish that kind of we're typically used to seeing, right? So, but I guess in terms of a broader, you know, let's say there is more market volatility, the financing environment gets worse. Well, I think the real risk here is that these deals do get stuck on bank balance sheets, right? And these are for highly leveraged companies. So for banks, they need to kind of think about holding on to more risky loans that they were not anticipating of holding on to. So really, I think it's really a capital ratio issue, right? And so in terms of the risk-weighted assets that they would have on the balance sheet, that the denominator of the capital ratio would go up, and then on the top line, they would need to hold more provision for. They need to build their loan loss reserves, right? And that would mean taking a bigger kind of provision expense to hold against that. But just to kind of put this all into perspective, though, right? Compared to pre-crisis, the amount of kind of these leveraged loans that are out there are a lot smaller, right? And the banks are a lot better capitalized, right? And so, take B of A. I think B of A is one of the leaders in the leveraged loan space. So maybe there's a little bit more concern there with B of A. But and their capital is pretty healthy. Although the 100 basis points of excess capital they have, that's about $18 billion, right? So in terms of if these loans do get hung up and everything else was okay, they have plenty of capital to kind of offset any potential losses.
I gotcha. So don't worry too much about it. Now let me take the flip side of that. Assuming that things settle down at some point. What would be the bank bond reaction? Is there any bond that might stand out more than another should the markets heat up again?
Got it. Yeah, in an active M&A environment, I think if we go back to, if we can rewind pre February 14th, before the invasion, I think if every sector had booming M&A, right, and we still have had M&A continue, right? But if we kind of roll that time back, and then I think the bank bonds can actually outperform other sectors potentially. Other sectors you might have huge bond deals to kind of finance these deals, but in bank land, typically with these higher tight regulation, these deals are equity financed. Or they come from, you saw, I think it was BMO, you can ask Himanshu today, but I think it was BMO raising equity today to help finance their Bank of the West acquisition. But, or they would just kind of use extra capital that they have to kind of finance these deals. So, but in terms of, relative value, I think, with this heightened kind of volatility out there, I think people might say, oh, let's think about the companies that are more U.S. centric, less geopolitical risk. So where that comes into play, I think Citi is more internationally exposed. They have like 10 billion of Russia exposure. Their bonds already trade on the wide side, but I think that might continue given kind of that international exposure and the 10 billion of Russia exposure. But so maybe the more domestically oriented, let's say Wells Fargo's or the B of A's might actually be where you might find some relative value.
Awesome, thank you. Let me move over to Mike Campellone on the retail side. How you doing, Mike?
I'm doing well, Joel. Thanks.
Awesome. Now, I know your sector has been very active in deal making. Can you walk through for everybody what happened last year and if you think the trends are going to continue this year?
Yeah, absolutely. So last year we saw private equity's interest in retail return after really limited involvement in acquisitions in 2018 through 2020. And this was really led by the LBOs of arts and crafts supplier Michaels, who was acquired by Apollo, and home decor store operator At Home Group, which was acquired by Hellman and Friedman. So home goods and specialty retailers were largely beneficiaries of shifting consumer preferences due to more time spent at home, ultimately increasing the attractiveness of legacy and more traditional retailers like a Michaels. So the LBO of Michaels actually pushed rater adjusted leverage to above 5 times from about 3.5 times prior to the deal, increasing the amount of funded debt on Michaels' balance sheet by $1.6 billion. The deal was financed with $4.1 billion of new debt, over half of which was secured, and a $1.4 billion equity contribution from Apollo. So, shifting gears to what the landscape looks like this year, The department store Kohl's has really been subject to LBO talks. And while Kohl's adopted a poison pill in February, after the company said the offers it had received were too low, we expect Kohl's will continue to face pressure to consider a deal, and a potential deal that could require over $9 billion in total funding. So yeah, that's kind of where we were and where we're at now.
That's great, Mike. And I want to get back to you on Kohl's and also Macy's and potentially separating assets when we get to the single name area. But why don't I jump over to Jody? How you doing, Jody?
Good. How are you, Joel?
I mean, I'm living the dream, Jody. Always living the dream. All right, JL. So on the gaming sector, there's been a ton of asset sales over the past year. Maybe you can walk us through some of the more unique deals that have happened.
Absolutely. So in the casino space, we've seen quite a lot of assets moving hands, and beyond just your traditional MGM selling Mirage to Hard Rock, which is in the process. We also saw very unique sort of situations. For instance, Las Vegas Sands, where Las Vegas is in the name, just closed out on their sale of all their Las Vegas assets. Now, the company is staying in Las Vegas, at least from a headquarters perspective. They're moving their headquarters within Las Vegas, but they are solely at the moment focused on their Asia properties. What's more unique that's been happening, and we saw this for MGM and for Wynn now recently, is the sale leaseback transactions. So MGM started sale leasebacks before, it was like 5 or 6 years ago. They started, spinning off assets into a REIT structure and creating quote unquote additional value doing that. But it's sort of a weird situation. And the reason why it's weird, particularly in MGM's case, is we've had such attractive financing over the past few years, but the company opted instead to sell off their properties. And they're selling it off primarily in triple net leases. So they're still paying insurance and taxes and CapEx and OpEx on the facilities themselves, but they're only operating the facilities. They don't actually own the underlying property. They did get a substantial amount of cash, which was beneficial leading into the pandemic and during the pandemic, and they're in a better position than some of their peers because of the amount of cash that's still coming in the door from it, but they don't own any of their US properties. And when you look at the actual sale leaseback, they're operating leases, so you can back that into leverage. But there's a step-up provision so that it's 2% or 3%. There's a cap at 3% every year that it goes up. So it's sort of like a step-up bond in addition to these fixed and variable costs that they have to pay on top of it for the rental expense. So it's a little bit more complicated than your traditional sort of fixed income situation where if they went out to the capital markets and just borrowed a ton of debt to supplement the balance sheet and to boost up their cash. Now, Wynn's situation was a little bit more attractive. They're only selling the Encore Boston property, but they too are using it to boost up their cash. Their terms are a little bit more favorable. MGM's definitely betting more on, in no pun intended, betting more on the inflationary environment that we're starting to see now, and expecting that persists, and perhaps they can outperform from that standpoint. But overall, the gaming space is just such a hot market in terms of selling assets, and then of course going into iGaming as an alternative and really building out those facilities. And you're seeing it on the Caesar side where they've been calling back a lot of their properties. They've been refocusing their properties and also building out their iGaming, and so is MGM, so is Wynn. It's definitely a very interesting time in the gaming space because of all the moving parts that are happening and keeping track of all the different properties and who owns what now.
No, that's really great color, Jody. And I'll get back to you on the hotels. But since we have you here, and I know you just did some great due diligence out in Las Vegas, maybe you could just give us a sentence or two, like, how are things out in Vegas?
I was very pleasantly surprised. It was 2 weeks ago, and my expectations were that it was still not quite, pre-pandemic. And I walked in at 1:30 in the morning, checked into our hotel, and it was just, the place was hopping. It also smelled a lot like cigarette smoke, even with an N95 on, but majority of people weren't wearing masks. I think the not wearing masks piece has definitely created more normalcy, but the whole city just seems to be both expanding from a real estate perspective, but also really back towards normalcy. The biggest challenge now, which is not so much an M&A topic, but is their ability to staff up to meet the demand that's currently there.
Right, right. No, that's great color. Thank you so much. Now
Sure.
I'm going to transition over to food and beverage. We know food and beverage is typically one of the more active sections. So let me bring in Mary at this point. Hey, Mary.
Hey, Joel.
Hey,
Yeah, so, oh, sorry, go ahead.
No, I was just going to, we're probably going to say the same thing. So I know your sector is very, very busy with activity. You know, when you think about acquisitions in 2022, what are the risks to the bondholders in terms of M&A?
Yeah, so the risks to the bondholders have to do with the size and how those transactions are going to be financed. So for example, if you look at, let's say, 2021, M&A in food and beverage was fairly robust, with over 900 transactions valued over 80 billion. And that's according to Bloomberg's MA function. And that's up from 73 billion in 2020. And the year was really capped with Coca-Cola's $5.6 billion purchase of body armor, which was funded with cash. So when you talk about like an A-rated company, it's really credit neutral in the near term, and actually potentially positive given that body armor was experiencing a growth rate of 50% at the time of the transaction. So in 22, the focus is really going to be on what's happening. And the big potential merger is Constellation Monster, a combination that we think is one to watch. It was first reported by Bloomberg News in late November and again in February. The maker of Corona and Modelo premium beers, Constellation Brands, said they're weighing a transaction, and they have an enterprise valuation of 53 billion. Monster, which is debt-free, has a $40 billion enterprise valuation. We think that they could consider acquiring a partial majority stake to avoid the dilutive impact of a, let's say, stock for stock combination. And with a partial transaction, it likely involves issuing debt. And we think it could issue as much as 8 billion in new high-grade debt. And we think that could cause spreads to widen. So they're currently rated BBB minus, and we think that spreads could widen more toward, Molson Coors. So that's sort of how we view that situation.
I gotcha. It sounds like a monster of a deal for us to keep an eye on. Now, whenever there's a buyer, there's a seller, and I know that there are a lot of companies that continue to prune their portfolios. Who do you think are the bigger names that are out there that might still be looking to sell assets?
Yeah, so that's a good question, Joel. So, for example, Kraft Heinz in 2021, they sold Planters nuts and natural cheese, and that totaled over $6 billion. We think this year they may consider selling anywhere upwards of 5 billion for about 2.6 billion in revenues coming from non-strategic brands, and that includes Maxwell House Coffee. That was once valued near 3 billion in 2019, but with market share losses over the last few years, that's likely to be lower, especially with inflation on the coffee side. So looking at Kraft Heinz, of course, they just got restored to full investment grade with S&P restoring its BBB minus rating earlier this month. So we think that spreads there could tighten further, especially if they sell another large business. And in fact, S&P left room for another upgrade with their positive outlook.
There you go. All right, thank you so much. Why don't we go and take a little bit of a deeper dive into some additional single name activity and the implications for the bonds there. And let me start with Mike Holland, our guru with healthcare. How you doing, Mike?
Good, Joel. Good afternoon.
Good afternoon, Mr. Holland. I know you've been busy with some of the largest deals in healthcare. Bausch Health is in the process of splitting up Bausch & Lomb from Solta. What are the implications for the company's credit profile, and how should we think about the bonds?
Sure, absolutely. I mean, Bausch has been a name that we've been focused on actually for greater than 7 years now. And I think stepping back a sec with Bausch, I think if you look at trends broadly in healthcare over the last 5 years, you've seen a reversion back to sort of deconsolidation. You had hospitals and pharma companies from 2010 through 2015 doing a lot of deals and consolidating a bunch of assets and layering on a lot of leverage to do so. And Bausch, when it was Valiant, was one of the most egregious, right? So, when Bausch was doing those deals back then, I think it's instructive to think about the multiples that were on the industry, or 15 times EV to EBITDA multiple back then, whereas today we're about 8 times. There's been a change in spec pharma with those multiples. And so the company is looking to monetize and sort of unlock embedded value in its Bausch and Lomb business, which it bought for around $7 billion or so in the early 2010s. And essentially, Bausch and Lomb is basically a consumer packaged goods CPG company and should garner a multiple higher than 8 times. So the company is looking to spin that out through an IPO, which is likely to happen. Probably, I mean, the CEO was on TV yesterday saying that he's been monitoring the markets and looking to jump in any day now. Basically said they're watching the VIX, and once the VIX comes down to a certain level, they're going to try to IPO Bausch & Lomb, which will in turn drive some proceeds that will be used to pay down debt. It's a big deal for Bausch because even though they paid down over $10 billion of debt in the last couple of years, leverage is still at 7 times. And if you look at the company's bond chart right now, it's inverted. The spreads, basically yields on the short end of the unsecured curve are about 8%. If you go out the curve, we're at 9 or 10%. And part of that has to do with the fact that some of its pharma products, some of its big blockbuster drugs are, don't have a ton of revenue durability, and they're looking at competition coming online over the next few years, which would really erode the company's earnings base. So when we look at Bausch today, which is really topical, they're looking to, Bausch & Health is looking to spin out the Bausch & Lomb business, as well as the Solta business, and then the RemainCo business, which is where the debt is going to reside after a small pay down on the front end of the curve. The RemainCo business is going to be levered to a very questionable long-term durability of this drug Xifaxan, which is under pressure with a competition right now. There's a trial going on that we've been writing to. Alvogen is looking to bring a drug on market, but what we're seeing is, it's more of the same in healthcare, where there's always consolidation and there's always deconsolidation. Right now, I mean, if you look at the PE side of things, last year in 2021, biggest year ever for the PE-sponsored LBOs and that sort of thing. We had Athena Health, we had Medline, $34 billion deal, $17 billion deal, a ton of activity in the space, and keeping track of the impact on the capital structures is definitely a challenge. With Bausch in particular, we're going to learn more soon in the next couple of days, so it's one to keep your eye on.
Right, and when does the lawsuit play out? And how many months does that take for?
With lawsuit? there's
over Xifaxan, over the drug.
Yeah, so the patent challenge to Xifaxan, which Xifaxan was part of the company's Salix, which Valiant bought in 2016 or 2016, completed the deal and paid $13+ billion for it. The drug's done very well. Since 2016, we've gone from 900 million to 1.6 billion. But the question is, how long is that revenue going to stay with the business? And we don't know. I mean, I'll defer to the litigation analyst. We've got a great new patent litigation analyst that just joined BI that is at the disposal of terminal users, who's ramping up. And, I think that there's a bench trial right now in Delaware. It's 4 days, and we'll have, 3 to 6 months maybe before we get an answer. There's always a possibility that Bausch would settle or Alvogen could settle. But it remains to be seen. And as a result, there's a lot of concern and investor trepidation around stepping in to these distressed yields at Bausch on the long end of the curve, over 10%, without any real idea about what's going to happen. What I've seen in the past 15 years that I've looked at the space is, that RemainCo, if Bausch & Lomb is IPO'd and Solta, the RemainCo at some point could get gobbled up by somebody else. There's always M&A for cash flow producing assets. So more will be revealed.
There you go. Okay, one for us to keep our eyes on. Thanks. Let me also turn to Steve Flynn. How you doing?
I'm good. How are you?
I mean, I'm always happy when I'm talking to you, Steve. So how can anything be bad?
Then,
now you had the largest deal of the year, I think, with AT&T and Warner Media creating Discovery, and I think that was about $43 billion. So first, maybe take us through the implications through the lens of AT&T. How did the sale impact the credit profile?
Sure. So yes, this is, I mean, there's a few deals going on in the communications sector, and this one is the largest. Yeah, first we could tackle it from the AT&T perspective. This deal is going to enable the companies to significantly lower its debt load and place AT&T on a path to achieve its net leverage goal by year-end 2023, which should further support its mid-BBB ratings from both Moody's and S&P. So that's good. Listen, AT&T's debt pile is enormous. The company has $187 billion principal value of debt. It's the largest non-financial name in the Bloomberg US Corporate Bond Index. So now next month, the company's going to spin off its Warner Media subsidiary and merge it with Discovery. And there's going to be a series of transactions that go on with the deal, whereby AT&T is going to lower its net debt balance by about 39 billion. Proceeds are expected to be used for debt reduction. Now, AT&T is still going to be a very large name in the index, but they're likely going to lose their top rank, excluding banks, and for non-financial names in the index to Verizon. Verizon will probably move ahead of them, or AT&T, I'm sorry, will move below Verizon. The new AT&T is going to be able to hit its net leverage goal of 2.5 times by the end of next year. It's going to do that even though it's going to continue to invest in its core telecom business, wireless, fiber, etc. AT&T, as part of this deal, is kind of resizing their dividend, which is going to allow the company to produce a fair amount of excess free cash flow, which they're going to use for deleveraging. So what does this mean for AT&T bonds? So if we look at AT&T bonds versus all the other bonds that are rated mid-BBB in the index, we could see that AT&T's curve is steeper. I think that's because AT&T is likely going to target a lot of the shorter dated bonds with the debt pay down from the Discovery deal. And I think there is room for AT&T to tighten as the company executes on its plan and delevers as it's expected to next year and get below or at 2.5 times net leverage.
Yeah, no, that's great. That's great. And let's put on the cap of Discovery. They become a massive $52 billion leading content provider. So what's the damage to the Discovery credit profile, and how quickly can it delever?
Yeah, sure. So yeah, Discovery is going to see their net leverage jump to well into the 4s, maybe almost 4.5 times. The debt load is going to ramp over $50 billion. Yeah, you know, the new Discovery Warner Media, it's actually to be called Warner Brothers Discovery, should be a free cash flow machine. They're going to use all the free cash flow to reduce leverage to less than 3 times within 2 years of the deal close. So I guess we're looking at, like, you know, April, maybe mid 2024. And the company has, you know, a long-term target of 2.5 to 3 times. So hopefully they'll stay in that range. About 2 weeks ago, AT&T's Warner Media subsidiary sold $30 billion of bonds to help fund the deal. The bonds were sold at a large discount. They've tightened here, but they're still outliers. If we look at Discovery's existing notes, they're rated low BBB across the board. They trade at a discount to most peers and have tightening potential, given the potential for significant credit profile improvement. All the rating agencies have affirmed the low BBB credit rating for the new Discovery.
Yeah, no, that sounds really interesting. Thank you, Steve. Let me go back to Camp and Mike, and your story with Kohl's and Macy's. Now both of them are under significant heat from activists who have looked to separate the e-commerce units from the traditional brick and mortar assets. So help us understand what the activists are thinking about and how we should overlay that potential event risk into their bonds.
Yeah, you're absolutely right, Joel. And so really the industry-wide rise of e-commerce was, you know, accelerated by the pandemic, with all of us buying things online. And some legacy retailers, like the department stores with both brick and mortar and e-commerce businesses, have been subject to this activist pressure calling for a spin-off of the online businesses. And this was the case that we saw with Macy's that really started at the end of last year. So this type of spin-off is largely just a way to try and extract value via financial engineering, and was really sparked by Hudson Bay's own Saks Fifth Avenue, who split its physical and digital businesses. So with Macy's specifically, they've been able to cool the spin-off pressure really by re-emphasizing the importance of an omni-channel approach. That's really the song that these department stores have been singing for the past couple of years now, so it was nothing new. to really leverage the most from their physical and digital properties. Beyond the department store space, Dollar Tree is another retailer who had to deal with activist pressure after earlier this year, Mantle Ridge called for replacements to its board and also pushed for it to hire the former CEO of Dollar General. Kind of a different in structure and different pressure points that Dollar Tree was facing, but they ended up making those changes in early March, adding 5 new members to the board and naming the former Dollar General CEO as executive chairman. And kind of a situation that we view as a potential credit positive and not something that we're often found saying when activists involved, but we think that there's opportunity for changes at Dollar Tree to really take hold of initiatives that the company's been trying to execute on the past few years, and could be favorable for the bond. So that's one name that we're watching there.
That's great, Mike. And I know Jody's area, that at least in the hotel space, has also gotten hit with private equity, but it doesn't sound like that's been as positive as it might be for Dollar Tree. So Jody, how has the private equity investments helped or hurt company strategies?
Sure, Joel. So I think what's so interesting about the private equity involvement that's been in the hotel space is that the main companies, so your Marriotts, your Hiltons, and your Hyatts, haven't really been so much affected, at least to the negative side. And you think back to Hilton when they were an LBO and then they were brought public and they've sort of shed that LBO self. But what we've been seeing instead is things like extended stay getting taken private and large sort of segments of the market, specifically these lower tier as well as extended stay positions getting taken out by private equities. And what does that tell us? Well, we've seen that those part of the market they were the hottest part of the market the past couple of years. And I think a lot of private equity firms are betting on the fact that these segments of the market, whereas they're not as sexy as the high-end luxury, but they are the part that's more appropriate for this post-COVID time, particularly the extended stay side, where you have the full kitchen. It's more traditionally similar to your Airbnb. And so they're betting that people are going to have preference towards those parts of the market as compared to what you see on the traditional luxury side. Now you have someone like Hyatt that's sort of taken a different approach, and they bought Apple Leisure a few months ago for over $2 billion, $2.7 billion. And what they were saying there is, we have all of our high-end luxury businesses, and it's very dependent on conferences and events and on urban market. But now we're taking a stake in these luxury areas beyond just your traditional urban market. So looking into Mexico and the Caribbean and Europe and looking at these resort areas to get people to go. And then also doing things that are a little bit more of the travel business side of things. So trying to tap into a whole different side of the market, while at the same time shedding a lot of their assets to be more fee-based, like a lot of their peers.
Interesting. Thank you. Thank you. Let me bring back Mike Holland. Mike, I know you've been working on another large deal, United Healthcare, and their legal battle with the DOJ over the acquisition of Change Healthcare. Obviously, the administration seems to be pumping the brakes on potentially anti-competitive transactions. So how does this challenge transaction frame M&A views for the healthcare system space?
It's a really good question. We've been getting a lot of inbound calls on, what does this mean for the broader state of the market? And I think if you look at United, they've always been an industry leader, an industry bellwether, really, in terms of investing into areas of growth and where the puck's going to. They've grown Optum to such a behemoth and such a large component of the business that they're now at the point where the government is saying you can't really grow much more. And so United was always a strategic buyer of good assets that were out in the market. And what I think it means now is, if this deal, which it looks to be the case, they're not going to buy Change Healthcare. Well, they're in the process of trying to buy Change, but the DOJ is now suing to prevent that. What that means to me is that you've got an administration that is, definitely got their eye on large anti-competitive behavior. And frankly, UNH and the big health insurers out there have a lot of clout. You know, you look at what just happened with Centene. Centene's CEO, Mike Neerdoff, just stepped down after 30 so years, and they hired a new CEO who's got a big background in, she actually worked for Optum in venture capital. And, you know, what they're going to be doing probably is investing, and they've got a ton of insurance premiums coming in, and they use that, the dollars coming in to invest in the space and really invest in growth. If it's not United buying them, maybe it's another insurance company. Maybe it just opens up the space for different strategics to grow. Maybe it opens up the opportunity for more private equity to come in and really fuel that M&A, where, you know, United in the past was really the big behemoth that was always kind of the, you know, thought of to be the buyer of last resort in some cases.
That's very helpful. It seems like you have as much watching of the legal dockets as as you do credit analysis.
Indeed.
For sure. Let me bring in Steve Flynn. Maybe we could wrap it up with Lumen, which some of us old folks know as CenturyLink and Embark. Steve, like AT&T, this is another large telco looking to reframe its balance sheet after years of M&A and selling assets. You can only understand through this company how much Arnold loves the M&A game and the fees that his companies generate off of it. So please take us through what asset sales are going on at Lumen and how we should think about where the balance sheet can go.
Sure. Thanks, Joel. So yeah, Lumen Technologies, they've got, you know, they're one of the bigger names in high yield. They've got a $31 billion debt load. Yeah, they may look to slash that debt load by about 25% in the second half as they execute two major asset sales. They're likely to close early third quarter. They have a gross value of about $10 million of two deals, and they should provide net.
Steve, you're
selling. What's that?
I'm sorry, your volume came off for a second. Maybe you could just repeat the last line. All right, Steve. It looks like Steve's screen has frozen on us. Which are you there? There we go.
You okay?
We're good.
All right. Let's try this one more time. So two asset sales, $10 million. They should get about $8.4 billion in net debt relief. There's two deals. Number one, they're selling their Latin American assets to Stonepeak for $2.7 billion. In part of their incumbent local exchange telephone business, they're selling that in about 20 states to Apollo funds for about $7.5 billion. Now, Lumen's unsecured bonds, they're junk rated at B2W minus, and similar to AT&T, Lumen's bond curve is much steeper than the Gresham curve of peers, as they could look to use the proceeds to reduce short-dated obligations. Now, unfortunately, where Lumen differs from AT&T, right? AT&T is improving. AT&T is going to hit their leverage target at the end of next year. Lumen has a leverage target, but it's not hitting it anytime soon. So Lumen's 3.6 times net leverage is not going to change, even though they're getting in all this cash this year. The core operations are going to see an EBITDA decline this year, a pretty sizable one, and that is going to occur as capital investments go higher. Lumen's embarking on a multi-year fiber upgrade plan for its network and is mimicking many of its junk-rated peers, including Altice USA, Frontier, Consolidated Communications. These are all companies that have declining EBITDA and rising capital investments, which is a really tough combination for any company's credit profile. So as a result, Lumen's 3.6 times net leverage ratio is going to be unchanged. And it has a ratio of 2.75 to 3.25 times, which would be nice. And they threw that out a few years ago, but now they don't expect that to hit that level until they complete their fiber upgrade plan, which is going to last 6 to 7 years. So, I've written some articles recently. I think about Lumen, I think about Consolidated, I think about Altice USA. These companies may never hit their leverage targets because there's so much CapEx spending right now, with the goal of business coming back in the future and driving higher EBITDA, which is quite uncertain.
Gotcha. No, that's really great. And it's a really interesting way to wrap things up. Let me thank everybody on the panel for this. And why don't we transition, Lauren, towards relative value as the second component of our analysis today. As an analyst at Bloomberg, we have the luxury of having the indices, great data, and tools to help frame relative value. One of the cool things we can offer all of our clients is that any of these components can be transparent to you simply by clicking our charts. They'll open up for you, it'll refresh pricing so you can get fresh pricing on it. And what's even better is that you can save them and make them your own, and you can send them either to your PMs or to other clients or internally throughout your groups. So it helps make you and your teams more productive, or certainly that's one of our hopes. For the relative value section, we have Rob Schiffman, our team leader and our tech specialist. We have Dave Havens, who covers specialty finance and REITs. Spencer Cutter, senior analyst covering the energy sector. Himanshu Bakshi, who covers Canadian and Australian banks, as well as the exchanges. And then Matt Geudtner covers the aerospace sector, as well as an array of high yield industrials. So why don't we kick it off with Rob? Rob, why don't you take it away?
Hey, thank you. I was a little saddened that I didn't qualify for the M&A panel, because I actually have the largest M&A deal the last couple of years with Microsoft buying Activision for $69 billion. But when you're in tech and you can just write a $69 billion check, people don't care as much. So we're going to focus on relative value. Listen, one of the things that our team does is every quarter we write a picks and pans deck. It's across investment grade and high yield in the US, Europe, and Asia, where we're constantly just trying to highlight value, both good and bad. Today, I'm going to talk about Alibaba. I meant Alibaba, which I'll try to make quick since mentioning this name and seeing it on the screen, half of you probably just shut off my audio and want me to go see a therapist. That being said, Baba is the largest e-commerce retailer in China, but they have a very well diversified portfolio of assets, including cloud, logistics, digital media, and entertainment. They're sort of like the Amazon of Asia. The thing that I like is that bonds are super liquid. They trade all across the curve, whether you're looking for 1 year duration or you're looking for 40-year bonds. And on a dollar price basis, this is sort of good and bad. But some bonds trade as low as 70 cents on the dollar, so they can be found very, very cheap. When something trades at 70 cents on a dollar, there's a reason. It's not just going to be rates, but it's going to be spreads. They trade meaningfully wide to peers. There's a normal EM discount that exists, and historically the average has been about 50 basis points. But Baba trades on more than 100 basis points wide to comparable US peers, which I think creates opportunity. And they have massive financial flexibility, which we'll talk about, with a giant cash hoard and even as big of a consumer base. So this credit is rated A1, A+, stable. Seems like a pretty great story. So what exactly is the problem? The main problem is China. The vast majority of the revenues come from China. Increased regulation is happening, and we're seeing slowing growth and rising expenses. The company's moving to more of a retention story than a growth story. And as they're doing this, the stock has fallen over $500 billion. That's right. They've lost more than $500 billion of equity market capital, but they still have a value of over $300 billion. So if we go to the next slide, and we'll just start digging a little bit into some of the specifics. From an operational standpoint, this name has scale. They've got an enormous customer base. They've got over 1 billion annual active customers. And though some might be worried about their rate of growth slowing, you need to put it in perspective that the rate of growth has been significantly higher than the rate of growth for almost all corporates, and even faster than internet peers in the US. Their top line in fiscal 2021, which is calendar shifted, is going to likely be a little over $100 billion. Consensus thinks that's going to grow to $135 billion in 2022 and $150 billion in 2023. So though valuation from an equity standpoint is concerned about slowing growth, the company's still growing, and it still has massive size and scale. they're being asked to pay a lot more for the common good in China. It's called common prosperity spending, and they're anticipated to spend about $15 billion over the next few years to help fund that. But even with that type of funding, we think free cash flow is going to be considerable. And finally, though its core business might be stabilizing, they still do have growth businesses, in particular the cloud. So we can move on to the next slide. So what gives us comfort? You know, I get comfortable with a name in China that's being overregulated, whose stock has gotten annihilated. And oh, by the way, just the other day, they announced growing their share buyback to $25 billion. Well, the way that you get comfortable is that they're well overcapitalized. They have dramatically more cash than they need, and they're going to continue to generate more. Alibaba is sitting on $75 billion of cash with a massive negative net debt position. Now, you did not hear me wrong. Alibaba is sitting on $75 billion of cash. It goes a long way to protect the credit and protect the credit ratings. You know, and other than the largest mega cap names like Apple or Alphabet, there's almost no corporates that are as well capitalized as Alibaba. Next slide, please. Listen, everything has a price. So, you know, love something, hate something. It really depends on where it trades relative to others and where you think it might end up trading. Alibaba bonds across the curve trade at a pretty steep discount to all their US dollar peers. And listen, it's for a good reason. There's lots of things to be concerned about. But we believe that discount is just overdone. And the combination of significant excess carry, it's more than 100 basis points across the entire curve, as well as what I think could be mild spread compression with the equity feeling like it might have reached bottom, can lead to excess return outperformance over the next 12 months. Now, listen, total return outperformance is very difficult. I'm just pulling out rates, but just on a pure excess return basis, which is what most investment grade bondholders are thinking about. I think this name is much better positioned than the headlines suggest. And for those of you that don't know the story that well, the one differentiation between BABA and Tencent is that BABA's bonds are registered, and they have very limited maturities over the next few years. So that, to me, means that technicals are likely to hold up pretty well. And I would say, even though bonds have been wider, are actually going to be strong to quite strong. Next slide, please. So when we think about this combination of rate moves and spread widening, what's it led to? There's a significant number of bonds that are trading below par, and some are at these deep discounts as low as the low $70 range. I just don't think that's gonna, listen, I don't know where rates are going again, but I think as you start getting these sort of discounts, people start getting interested, especially when the default risk is effectively zero. When you have enough cash to pay off all your debt tomorrow, with you know, I think it's hard to see bonds trading in the 60s or 50s. That being said, if you can hedge out interest rate risk, you can still find pretty decent discounts here. To me, I think China regulatory headwinds are likely reaching a peak. You've seen that with the statements out of China over the last few days. You've seen that in the recovery of BABA's stock. And they have abundance of financial flexibility, as I mentioned. So, you know, if you can stomach a little bit of short-term volatility or intermediate to long-term outlook for BABA's credit, as well as relative return potential, remain high. So I hope you weren't scarred by that. And maybe we'll move on to a little bit more straightforward things. Up next is our specialty financial guru, David Havens. Take it away, Dave.
All right. Thank you, Roberto, and good afternoon, everybody. I'll be spending a few minutes with you discussing Service Properties Trust. Bonds are BA2, B+, credit watch negative. This is not a distressed credit, but it is a perturbed one. Bonds are in the 6 to 7% range from a yield perspective, with unsecured notes ranging from par for the 2022s to $80 for the 4 3/8 of 30. We see good value in the bonds, and we think it should have the wherewithal to address liquidity and covenant breach matters and probably right the ship later in 2022. If we're right, we think there could be 150 basis points or so spread tightening potential in the bonds relative to comps. We can move to the next slide, please. The background is important here. Service Properties Trust, which some of you may have known in its prior life as Hospitality Property Trust, acquired a portfolio of net lease retail properties for $2.4 billion in cash. That deal closed in September 2019, just a few months before we learned about coronaviruses, ventilators, N95 masks, ivermectin, and all sorts of other things. So bad timing. Bad timing for a cash deal that relied on some asset sales for funding. The acquired portfolio actually held up really well during the pandemic. Many of the properties that they acquired were truck service centers on the interstate highways, which were a hive of activity as things were trucking around the country, even during the pandemic. But it turns out the pandemics and hospitality go together about as well as a fish and a bicycle, which means that they're not very compatible. This weighed heavily on Service Property Trust performance. So hotels accounted for about 60% of the $12 to $13 billion property portfolio after they made that acquisition. Next slide, please. This slide is important. It really sums up a lot of what's going on here. So Service Properties levers up a bit to fund its acquisition in late 2019, right before the pandemic, still intending to hold on to low BBB ratings to diversify more into non-hospitality net lease properties. That's not a bad move from a credit perspective. But then the pandemic hit. Market sees some planned asset sales fall by the wayside. The delevering doesn't go as planned. Travel stops. People stay away from hotels. Revenues and earnings get slammed. You can see that its debt service coverage ratio cratered from a coverage ratio of about 3.5 times pre-pandemic to a nadir of just over 1 time in the second quarter of 2021. Breached its bond covenants, which called for a 1.5 times coverage ratio. But before it did so, it drew down on the entirety of its $1 billion bank revolving credit facility in order to maintain financial flexibility. If we could flip the slide, please. So let's take a quick detour here before we get back to liquidity. This is not just a liquidity story. This is also a pandemic recovery story. As you can see from this slide, EBITDA is recovering. It's a little bit busy. The magenta is all total EBITDA. Company didn't used to break it down between property types. The sort of gold color or amber, whatever that color is net lease, retail, and other properties. The blue is hospitality. And then the forecasts are in lighter yellow. So that explains all the color coding there. But anyway, what you can see is that EBITDA is recovering. Hotel EBITDA transitioned back into the black in 2021 as the economy reopened and as people started moving around the country again. Omicron and seasonality hampered results in the fourth quarter of 2021, probably in early 22 as well. But hotel EBITDA stayed positive even in the fourth quarter of 2021. The outlook is improving. Next slide, please. But there's still the nettlesome matter of the covenant breach and a mountain of debt maturing in the summer of 2022. Billion-dollar bank revolver comes due in July 2022, and then in August 2022, we've got a $500 million debt maturity. So $1.5 billion of debt has to be dealt with this summer. How on earth is Service Property Trust going to deal with this? Well, as of year-end 2021, the REIT had $944 million of unrestricted cash. If you look at the slide I provided, I do have a little typo there. I showed it as the third quarter of 21. That should read fourth quarter of 21. I'm a newbie trying to still work out the systems here, so that's on me. Anyway, with a much better tone in the second half of 2021, the REIT placed a portfolio of 71 non-core hotels on the market with a book value of $579 million. They said that they expected to complete these sales near book value by the first quarter of 2022. Next slide, please. In February, the REIT disclosed that it had reached agreements to sell $430 million of properties already, and that an additional $132 million are in the hopper and are expected to close in the second quarter of 2022. So we're a little bit behind schedule. Thank you, Omicron. Thank you, maybe Russia too. But they are basically doing what they said they would do, which is good news. So $560 million of cash is going to be rolling in the door from asset sales on top of $944 million of cash at year end. So by mid 2022, when all this debt comes due, they ought to be in a pretty good position. It appears to us that Service Property Trust should be able to meet its 2022 debt obligations, even if the markets are sealed up tight as a drum for some reason, which doesn't appear to be the case right now, but who knows a few months down the road. More likely, the REIT will term out a portion of the bank debt and maybe tap the credit markets to replace the maturing debt. And if things continue to go well, you might even see the covenant breach cure itself. Next slide. This leads us to relative value. As you can see, Service Property Trust's credit curve trades 100 to 200 basis points wider than non-investment grade real estate comps. If or when it gets its 2022 debt maturities in order, which we think it will, especially with some help from the pandemic easing, then we think spreads could actually converge with peers. So, 100 to 200 basis points of spread tightening, I think, is on the table if things go well, and they seem to be going in the right direction. Managing 2022 maturities is the catalyst here. Pre-catalyst of selling properties, I think we could check that box for the most part. Maybe down the road, we'll talk about restoring 6B ratings at this REIT, but that might be at the 2024 FIAZI chat that we have together. That's it for me. I want to thank you for your time and interest, and now let me turn it over to my colleague, Spencer Cutter, for a cutting-edge analysis of the energy sector. Spencer?
Great, David. Thank you very much. Spencer Cutter, a senior analyst covering the energy sector. Today, I'd like to talk a little bit about what we're seeing with the run-up in oil and natural gas prices, which have hit sort of the highest level in about a decade, and what that may mean with regards to sectors that may present some opportunity and some others which may warrant some caution. On the next slide, one would naturally think that the biggest beneficiaries to a huge rally in oil and gas prices would be the independent oil and natural gas producers. However, at least from a fixed income standpoint, one would be wrong. Based on what we've seen year to date, you might be able to come to the conclusion that the sector's best days may be behind it. Bondholders may experience only modest benefits from the windfall that oil and gas companies are going to see this year. Part of that's due to the fact that as we entered this year, independent energy bond yields pretty much had nowhere to go but up. If you look at the chart on the left, you can see the yield for the Bloomberg high yield and high grade independent energy indices. They hit all-time lows middle of last year and have obviously climbed since then. Now, everybody on this forum is obviously, I'm sure, well aware that a big chunk of that is that underlying treasury yields have started to climb. So as a result, absolute returns throughout the sector have been negative year to date, but it's not just total returns that are struggling. As you can see on the right, credit spreads are also struggling. Spreads for most bonds from independent energy oil and gas producers are as wide, if not wider today, when oil is $115 a barrel than they were back in October when it was around $85 a barrel, which obviously seems somewhat counterintuitive when over that same period from October till now, EBITDA and cash flow estimates have grown dramatically. I would argue that the reason for this subdued reaction to the run-up in oil prices is that very little of this windfall is likely to accrue to bondholders. If you go to the next slide, please. After a series of near-death experiences since 2015, many oil and gas producers have been heavily focused on paying down debt, and many have set long-term leverage targets in the sort of 1 to 2 times range. And as you can see from the table on the right, pretty much everybody out there is going to hit that target, if not be underneath it by the end of this year, if not already. And with those targets achieved, the focus has now shifted from paying down debt and reducing leverage to boosting shareholder returns. And everybody's doing that now in the form of increased dividends and embracing this new variable dividend phenomena, as well as share buybacks. And companies have gone so far as to say, we will make sure that we distribute a minimum percentage of free cash flow each quarter, either in the form of dividends or buybacks or some combination of both. That's generally been in the neighborhood of around 50% of free cash flow, plus or minus, but it has gone up as high as 80% in the case of Pioneer. On the next slide, please. One other factor that used to be a tailwind, so to speak, for independent energy credit and is now potentially a headwind is the M&A market. You had a record wave of bankruptcy filings in 2015 and 16, and then another wave, obviously in 2020. And many producers saw M&A as a way to not only just grow the reserve base, but also strengthen what had become a strained balance sheet. And as a result, if you look at the bottom part of this, deals from 2019 to 2020, vast majority of them were 100% equity funded. For example, 2020 Devon Energy was on the cusp of being the industry's next fallen angel. The company was already BA1 at Moody's, and S&P had them at BBB- with a negative outlook. They announced that they're going to make an all-stock acquisition of WPX, and S&P moved its outlook to stable and stay the company and now be AA3 BBB-. Over the past year, however, we've seen a growing component of cash compensation being used to fund these acquisitions. And to fund those deals, companies like Continental Resources and Southwestern Energy have had to issue billions of dollars in debt. And while at today's commodity prices, that pro forma leverage and credit metrics may look fine, a lot of that debt is long-term bond debt, and it's going to still be on the balance sheet for years, potentially when you see the next downturn in commodity prices. And I don't know when that will happen, but I do know it will happen at some point. On the next slide, it's not all doom and gloom. I do think there are some areas of opportunity. The oil field services and drilling sectors were the hardest hit since 2014. And while they have seen a substantial improvement over the last 18 months, there may still be some room to run. The yield on the left, you can see the yield on the the oil field services segment of the Bloomberg High Yield Energy Index is nearly double that of most of its other energy sector peers, and then Transocean, Neighbors, and Weatherford bonds on the right, you can see their credit spreads are 2 to 3 times wider than most of the high yield energy market. While many producers remain focused on capital discipline and generating cash flow that can be used to boost shareholder returns, drilling activity, rig counts, and day rates have started to climb over the past year. And I also think that the loss of Russian oil and gas could drive countries and producers to look for alternative sources. And one of the biggest potential alternative sources is going to be in offshore exploration and production, which should help benefit Transocean. Next slide, sort of moving to the midstream a little bit. Investors looking for some extra yield in a sector that, like I mentioned at the beginning, yields hit all-time lows last year. Might want to look for some structurally subordinated debt issued by some relatively strong companies. I'd argue that Cheniere is not only a relatively strong credit profile, it's supported by long-term fixed fee contracts with investment-grade counterparties, but it also, in addition to Transocean, may benefit from the disruption in Europe as Europe looks to diversify its gas sources away from Russia. Anybody who's looked at Cheniere your first takeaway is that it's a very complex capital structure. But for our purposes, there's debt issued out of the holding companies, and there's debt issued out of several of the operating companies. The holding company debt at Cheniere Energy Inc. and Cheniere Energy Partners trades at a pretty significant discount to the operating company level debt. That said, the company has said that its plan over time, as the operating company level debt comes due, is to refinance that at the holding company. And as that happens, the structural subordination issues and concerns should abate, and that discount theoretically should narrow. And it's also, those holding company bonds also trade not at just wide of the operating company level, but also wider than many of their other, call it midstream peers, such as Kinder Morgan, Williams, and Energy Transfer. And finally, if you've been following Cheniere, you know that they have completed pretty significant expansion projects in the last 6 months, really. And as a result, you really are going to see free cash flow, EBITDA, ramp up dramatically this year and into next year. And even, structural issues aside, it does put the company on a path towards a stronger credit profile, and they are talking about potentially at the holding company level getting investment grade credit ratings in the next year or two. And that's it for me on energy. And I will now hand it off to my colleague Himanshu to talk about financials.
Thank you, Spencer. Good afternoon. My name is Himanshu Bakshi. I cover banks and financial companies. And today I'll be talking about PayPal, which is an online payment system company. Please move to the next slide. So looking at these charts, we don't think that PayPal's bonds reflect its future growth opportunities and credit strength, and we expect the bonds to tighten from current levels. If you look at the chart on the left, PayPal's bonds used to trade about 20 to 30 basis points tighter than the bonds of Intercontinental Exchange, but have recently widened and now trade in line. Similarly, if you look at the chart on the right, PayPal's bonds were trading about 30 to 40 basis points tighter than the investment grade index and now trade wide. So what happened? Well, PayPal had a very tough 4Q due to some short-term headwinds and is now forecasting slower revenue growth. Also in early 2020, the company announced that they plan to grow active accounts to 750 million by 2025. But in 4Q, the management said they no longer expect to hit that target. So basically what happened was PayPal overestimated the benefits from the pandemic. Now, PayPal's new strategy is to increase user engagement and also revenue per active account, which we think is a good strategy because a vast majority of PayPal's volume actually comes from just a third of its customer base. So under the new strategy, we think it should help the company change that. Please move to the next slide. Now, looking at the fundamentals, so revenue growth is still expected to be 15 to 17% in 2022 and will exceed 29 billion, as you can see from this chart. These are all estimates for 2022. And EBITDA is expected to be over 7 billion, higher than ICE and other exchange peers. Now, this is despite the slowing revenue growth I talked about. Please move to the next slide. And now just looking at leverage, PayPal has about 9 billion in bonds outstanding. But as you can see, net leverage is just 0.5 times, as the company has about 5 billion in cash. And we expect leverage to stay low in the near term because we don't think the company will make any big acquisitions. But we'll still do some small tuck-in acquisitions in 2022, but not more than 1 billion, we think. Let's move to the next slide. Yes, thank you. So PayPal generated about 5.5 billion in free cash flow last year and is expected to generate about 6 billion in 2022. So as you can see, the company has a very strong cash generation capacity. And with that, just to conclude, we think that PayPal has strong fundamentals and it will continue to benefit from two things. One is growing e-commerce, and second, we think, is digitization of cash payments. And therefore, we expect the company's bond spreads to tighten in the near term. And with that, I will pass it on to Matt.
Hi, everyone. My name is Matt Geudtner, and I'm an analyst here with Bloomberg Intelligence. Joel and I, as well as our colleague Stefan across the pond, all play together in the industrial sandbox here at BI. For Boeing, the crash of China Eastern Airlines Flight 5735, which was a 737-800NG model and not a MAX, doesn't change our intermediate view that bonds can narrow the spread gap versus BBB tier industrial peers, but we think the event could put the company's bond under some pressure here in near term as regulators investigate the cause of the crash. And for them, pairing inventory and generating cash are key to cutting debt and relieving strain on their financial risk profile. And we think that Boeing's addressable debt through 2023 may total about 15 billion, which is comprised of maturing and callable bonds that represent opportunities to deleverage and keep hold of their high-grade status, with cash inflecting in concert with debt reduction of this magnitude, giving rise to our intermediate view that they can narrow the discount at which the bonds trade. On this slide, the three raters expect dividends and buybacks to be suspended through 2024, or at least until funded debt is significantly reduced, which means it's 16 billion of balance sheet cash and cumulative cash generation through next year, which may total about $12 billion, should be used exclusively for debt reduction for at least the next few years. We tried to illustrate this using Bloomberg's terminal functionality, which incorporates Boeing's sources and uses of cash, as well as the consensus forward look. And even though downgrade triggers comprise a mix of qualitative and quantitative factors, pairing about $15 billion of debt through next year would support key metrics broadly keeping pace with assumptions set for its ratings in our view. But obviously the path to restoring their risk profile is going to be protracted given leverage that's probably going to exceed 6 or even 7 times in 2022 with debt pay down tethered to the cash flow outlook. And a key lever, I think, is going to be the $9.8 billion of bonds they issued a year ago to help term out their delayed term loan, which contains provisions that allow them to call the bonds at par this year and in 2023. So if you turn to the next slide, Joel, Boeing's cash position has about a $6 billion cushion versus the $10 billion minimum that Moody's contemplates as part of their Baa2 rating, with funded debt reduction driving leverage down to around 5 times or less next year. This level of cash provides cushion to absorb the $1.2 billion of 2022 bond maturities while inflecting cash positive towards $3 billion. We think shows capacity to potentially retire $5.5 billion of bonds that mature or can be called this year. And under our scenario, cash could approximate about $14 billion at year end, ahead of stronger cash generation at about $5 billion of bond maturities in 2023. If you go to the next slide, Joel, the rise in the Moody's AA bond index, which can be used to help set discount rates in order to measure pension liabilities, helped narrow Boeing's underfunded pension position by about $6 billion last year. You can see the move on the index here, which can be found on the terminal under ticker MOODCAA. So the almost $8 billion of underfunding they still have left may equate to almost an additional turn of leverage on 2022 EBITDA. So obviously the liability bears monitoring, but the rise in rates while early in the year can provide a tailwind for adjusted leverage, given a revision upward of about 25 basis points results in about a $2.2 billion decrease in underfunding, which may equate to around about a quarter of a turn of lower leverage under our scenario analysis. And then if you turn the slide one more time, Joel, you'll see the relative value. You can see our fixed income worksheet function on the terminal, which is FIW Go. Boeing's bonds could narrow the discount versus rating tier peers over the intermediate term. The catalyst for the gap shrinking, supported by rising deliveries, improving cash flow, and these liability management actions that they're going to need to take. And I'd also note that investors are boosting exposure to their bonds among the most within investment-grade industrials, given that Boeing obviously has options to support deleveraging in line with their ratings, we think. Having said that, some but not all of their bonds carry coupon steps in the event of rating downgrades, which obviously is a bondholder consideration given their profile still is tied to the path of vaccinations, airline traffic, and issues stemming from the 787 and obviously the 737. So I'll pass it back to Joel for any closing comments he wants to make.
All right, thank you so much, Matt, and really thank you to everybody first on the BI credit team. It's always an honor to work with you guys on a day-to-day basis. Everybody can see why. It's just a tremendous amount of talent here, and one of the great things about our team, if you're a Bloomberg terminal user, you have full access to them whenever you want, as well as all of their research. Let me also thank Lauren and Ralph and the Fiazi team for the great job that they did. So thank you guys. And if anybody needs a copy of the slides, feel free to reach out to me afterwards. More than happy to send you a copy. So with that, let me send it to Ralph and Lauren if they have any closing remarks, or we could just end the webinar. Thank you.
Thank you, Joel, and everybody at Bloomberg Intelligence for taking the time and providing us with all that information. Please tune into our website at www.fiazi.org to keep up with our next events, or even better, to join Fiazi. I'm Ralph DeCesar, and thank you for joining us, and have a good day.